All right, today we're going to peek inside one of the most interesting, and let's be honest, often misunderstood corners of the investment world, structured products. They come with some really big promises, but what's really going on under the hood? So let me just ask you this. What if you could get all the potential growth of the stock market, but with an ironclad guarantee that you won't lose a single penny of your initial investment if things go south? I mean, it sounds a little too good to be true, right? Well, that is the core promise that makes these things so incredibly tempting. And the secret to how they even begin to make that promise is right here in the official definition. At their heart, they're basically pre-packaged investment strategies. Think of it like a chef taking different financial ingredients, in this case things like bonds and derivatives, and combining them to create a very specific dish with a very specific flavor of risk and return.
Okay, so let's pop the hood and really get into how they're built. We're going to deconstruct a really simple structured product just to see all the mechanics in action. And you'll see it's not as crazy as it might sound once you look at the individual moving parts.
So check out this classic example. Let's say you put in £1,000. The first thing the issuer does is split your money. The biggest chunk, say 800 quid, goes into something called a zero coupon bond. Now just think of this piece as your safety net. It doesn't pay you interest along the way, but it is guaranteed to grow back to your full £1,000 when the term is up. Now the rest of your money, that last £200, that's used to buy your lottery ticket, a call option.
So this call option is the really interesting part. This is the engine for all your potential growth. It's basically just a bet that an asset, like the FTSE 100 stock market index, for example, is going to go up in value. If it goes up, your option becomes valuable. If the market goes down, well, you just don't use it. And that's exactly what they mean by the right but not the obligation. There's no penalty, it just expires.
Which means, after those 5 years are up, it all boils down to two really simple outcomes. Scenario 1, the market is up. Your call option pays out. Fantastic, you get that return on top of your original £1,000. Scenario 2, the market is down. That call option you bought, it expires completely worthless. But, and this is the whole point, remember that safety net? The bond has done its job and you still get your original £1,000 back. Downside protected, upside potential. See? That's the formula.
Right. Now here is the crucial point. That basic recipe, a safe part and a risky part, can be tweaked and adjusted in countless ways. And this creates a whole menu of different structured products. And believe me, they are definitely not all created equal when it comes to risk.
You can pretty much break them down into three main flavors. First up, you've got structured deposits. These are the most conservative of the bunch. Then you move on to capital-protected products. These are aiming for higher returns, but they usually don't have the same government-backed safety nets. And finally, you have structured capital-at-risk products, or as they're known, SCARPs. And yeah, the name kind of says it all. These offer the highest potential returns, but in exchange, you are absolutely risking some or maybe even all of your initial capital.
But with any investment, there's the sales pitch, and then there's the reality. On the surface, the benefits look fantastic. But as with anything in finance, you absolutely have to read the fine print to really understand the catch.
I mean, the marketing brochure is always going to be screaming about these points. You get that capital protection we just talked about, you get the chance for way better returns than a simple savings account, and you can get exposure to markets you might not normally touch, like currencies or gold. It's all bundled up in a very, very attractive package. Okay, but here's the other side of the coin, the stuff they don't always highlight in big, bold letters. First, that protection isn't free. The fees can be really heavy, and they can seriously eat into your returns. And that potential profit, a lot of the time, it's capped. So even if the market goes to the moon, you only get a piece of it. They're also really illiquid. You're typically locked in for the whole term. But the big one, the one you see there in bold, is issuer risk.
And I cannot stress this enough. When a product says capital protected, that is a promise from the bank or the financial institution that issued it. It is absolutely not a guarantee from the government. Your protection is only as good as the company that sold it to you. If that institution goes bust, your protection and your capital could just vanish.
So, after opening up the black box and looking at all the gears and wires inside, what's the final verdict here? Are these sophisticated tools for smartly managing risk, or are they really just complex traps for people who might not know better? Well, as always, it really depends on the details.
And that leaves us with one final big question to think about. Remember, these products are so carefully designed. They're balanced with fees and caps and all these different risks. So now that you can see how the machine actually works, who is it truly structured to benefit the most?
Is it the investor looking for a safe return? Or is it the institution that gets to build it and set all the rules? Something to think about.